Okay, hello everyone. My name is Toni Vanschoyck, and you are here today. We started doing our weekly lunch and learns every Tuesday at noon, where we're giving you tangibles and business basics, wealth and freedom, and how to invest money, how to do the best practices for your business. So I have a podcast called Simple Wealth. You will also be able to find us on Spotify, Apple, and YouTube. And if you find this of value, please share it. So I have a very special guest with me today, but before we kick this off, I just want to share with a few of you who I am. I do recognize some names on this call that I don't know. This is going to be available for you today, so you can share this recording with potential people that are interested. But, Greg and I were coming at this from a completely different perspective, and then he dropped a bomb on me last week. And so I was like, I have to get this out to my, 1099ers, to people that are self-employed, because this is a big freaking deal. And I know it can help a lot of people, especially in this day and age with with things that are happening with the economy. And you guys, this is going to help out so much during the holidays. So with that being said, so I am a serialpreneur. I have been a corporate employee. I worked for a huge restaurant chain back in my early days, helped put me through college, which I'm very grateful for. I own my own brick and mortars. I had 2 of those. Unfortunately, those went away with the ex-husband. So don't know if that's necessarily a bad thing, because then I got started in network marketing, and I've been doing that in some form of capacity for over the last 25 years. And then back in 2014, we launched an incredible company. It is now almost $4 billion brand. I can't believe that I say the B word.
With a B.
The B word. But that scaled very, very quickly. And then, you know what? I made a lot of mistakes along the way trying to scale, and really trying to turn my business into turnkey entrepreneurism. So that's where we are here today, is that I get to share with you incredible practices, not only on how to build legacy wealth, also how to build, and you guys, I'm just going to tell you, if you are W-2'd, you are still part of the slavery system. So, because you're paying Uncle Sam first. So I am really big into doing your own thing. I have been for a long time. We have 9 different income streams. The main one is still the main one, though. It's just that we've been able to do things now that we've been able to grow our platform and do even greater things and share with people on what they can do. But without further ado, because this is not about me, this is about my journey and not making the same mistakes that I did, because I made some pretty expensive mistakes. But I want to talk to you about this particular, it's called SETC. It's self-employment tax credit, is kind of like the short-term version of it. There's another longer acronym, but we're not going to go into that. So when Greg shared this with me, and he's been playing in this space in infinite banking and ERC for a number of years. Okay. Then he dropped this bomb on me last week and said, do you know, Toni, he goes, do you know that every single person that 99% of people that I know is probably eligible for this. So without further ado, I want to turn it over to Greg. He has been in the financial space for almost 3 years, right?
Almost 4 years.
Almost 4 years. Okay. 4 years. You guys, seriously, we have one of his partners here on the call, so I'm going to put him on the spot. His wife is due with their second baby at any minute. So if he gets a phone call, he may have to go.
I get 2 phone calls.
Two phone calls. So anyways, we just wanted to have a backup plan here, but he came out here today because this is such an important topic to share on this potential $32,220 credit that you could be eligible for. I'm not the expert here. All I am is I'm taking someone that I know, like, and trust, that I've done business with in the past, that is no bullshit. And he's going to just share this simple, duplicable platform with you. And you guys, it really is super simple. Why don't you share a little bit about, with them about who you are, Greg?
Perfect. Yeah. Thank you for having me, Toni. My name's Greg Smith. I've been down here in the Low Country for a while now, but I got really into finance because I cut my teeth in the business. In the car business. That's where I learned my foundation of helping people, getting to understand people. And I know a lot of people have this negative stigmatism about the car business, and I tried to fight to be different than that. And that's what ultimately led me to getting out of the business, getting licensed in finance, and truly trying to help people. And then I came across this program actually through a very good buddy of mine who is also a mentor of mine, who has taught me how to help my clients achieve a 0% tax bracket in retirement. But for all of my business owners, my self-employed, we try to add value to them. And through that, that's where the self-employed tax credit has come into play, because ERC, most of you know about, has been around for a while, but self-employed tax credit is kind of like the little brother that nobody knows about. But I brought that to Toni, and it's exploded. So we're going to go over that. I believe she has her PowerPoint ready now. So it really started with just a simple conversation because I knew that Toni was self-employed, a 1099 solopreneur, right? You own your own LLC, you're a contractor. Most people don't qualify for the employee retention credit if you are by yourself, if you're a 1099 solo contractor. And she knew that. And she thought I was actually talking about that, asking for herself. And she said, no, actually, I don't qualify. I'm like, no, Toni, I'm talking about something completely different. This is for all of your 1099. And her eyes about popped out of her head when I said it, because she had so many people. But basically what this does is this allows you, if you were self-employed 1099 at any time during the 2020, 2021 timeframe through pandemic COVID, there was an act that was placed in force that allows you to receive a refund. This is not a loan. This is not a tax credit. I know it says it in the name, but it is a refund from the IRS for anything that caused you to miss work due to the pandemic. And we're going to go through that. So if we'll go to the next slide. So what is SETC? Technically, I know Toni said we're not really going to go into it, but it's technically the FFCRA, which stands for Families First Coronavirus Response Act. Signed into law March 18, 2020, and allows you, if you are eligible, to recuperate some of that lost, not necessarily lost revenue, but lost opportunity to make revenue. If you were sick with COVID, if you had a child, a family member that you had to take care of, or everybody that had kids, school was shut down, daycares were shut down. You had to alter your life because you no longer had daycare or school. So that is an opportunity you missed. And just depending on multiple different factors, which everybody qualifies for a different amount based on how much income you made and how much time you missed, the maximum refund you can receive is $32,220. That's a huge amount of money, right? Will everybody qualify for that amount? No. Will some people qualify for less? Yeah. Will some people qualify for it? Yes. That it's all dependent on everything that you've done. Now, a lot of people are going to ask Toni, they're going to say, well, is this like ERC, which is what you did? It is similar to ERC, except structured specifically for the self-employed. Now, if you are like, oh, well, I've never heard of ERC as well. So what I was saying is some of you guys are like, well, I haven't even heard of ERC. So if you are a business owner, and you employ somewhere between 5 to 500 people, small businesses, right, you are able to qualify for up to $26,000 per employee. If for some reason you had to shut down fully or partially due to a mandate, your business's gross receipts were down 50% over different quarters. There's a lot of different qualifying factors. But one thing that I've come across since working with tax prep advocates and knowing my mentor, he has actually helped, I can't tell you how many businesses where their CPA said they didn't qualify. He has met with those people, and he's recovered over 7 figures of people that their CPA either didn't know or they just weren't sure and they didn't want to take the risk of how to properly do it. So using tax prep advocates through your SETC or ERC, what makes them different is that they do everything. They basically dare the IRS to audit them and audit their clients, because they submit everything the right way the first time, as well as everything is pre-audited by the IRS. So this company has not popped up overnight. They use and employ one of the largest CPA firms in the nation.
It's the fourth largest. And you guys, I've actually talked to a couple of the owners from this particular agency, and they are stellar. I mean, we're talking 5-star. You know that I'm not going to come to you guys and recommend anything that I'm not using myself. So I actually have an appointment. With Stefan today to move everything over, just because it's a one-stop shop. So when you're thinking about this, when you have a business, right, and especially in network marketing, I wanted to have resources, because I have people come to me all the time with insurance, with tax questions, with investment questions, with I mean, one of the big things, and this is one of my, and I'll just give you an example, is that probably 80% of the people that I talk to do not understand how to write off their expenses for their business. And there's a lot that goes under advertising. It's a very gray area, and you can write off just about everything. That's just one example. So anyways, not to steal from your thunder.
Not a problem. That's all great information as well. But yeah, so credible people. You want credible people that have been in this space for a while, that know the ins and the outs of the tax codes, that literally nerd out on tax codes to be doing this for you. And the sad thing is that not every CPA goes to that extent. I'm sure they're all great, they're good people, but these people literally go above and beyond knowing the ins and the outs. So if your CPA, not trying to insult them any, but if they said that you do not qualify, it's worth a second look. Just like if you got a bad diagnosis from your doctor, you're going to go get a second opinion. Let us be your second opinion. And who knows, you might get some money. Worst case, they were correct. So, it's not too bad. But anyway, so moving on. So it's really, really simple. How do you qualify? Like I mentioned before, if you had 1099 self-employed income during the years 2019 or 2020, they like to take one of the other, whichever one's higher, and 2021. It doesn't have to have been all of those. You could have just had self-employed income for 2021. Obviously, you're not going to qualify for as much. But if you had 1099, a Schedule C on your tax returns during those years, you have the potential to qualify. Now, next, also determining how much. Did you have COVID illness? Did you have to quarantine because someone around you had COVID? Or were you taking care of a child during that time period? Then also, as I mentioned, did your business experience some sort of shutdown to a certain degree, a mandate that did not allow you to go to work or do full work from home because your kids were home? They didn't have daycare, as I mentioned. Those three things will qualify you. How much income, how many days you missed are different per person. So that's when we have our easy qualification process. So anything you want to add to that, Toni?
No, I mean, when I did the process, it was very streamlined and super simple. So you guys, just to let you know that if you made $136 in your 1099, your side hustle, or your self-employed business, you qualify for $1.
So just about everybody qualifies.
Right. But even if it's $500, $600, $700, whatever the case may be, maybe it's $250, maybe it's $10,000. I just had someone reach out to me. They're getting back $26,200. And
I just had my wife's about to have a baby. I just had my doula get qualified for $695 net. It's free money. It's money that you are going to get back from the IRS because you are self-employed. So
let me explain this too. It's money that's already been paid into the system that they have set aside for you to use. So the SETC and the ERC, they are no different. So I'll give you another example. So, and I'm still trying, it's not my thing, but I just know her really well. One of my really good friends that owns a restaurant here, she's eligible for $301,000. Her CPA told her that she wasn't eligible. And when I found out that she said that the other day to Melissa, I texted her and I said, "What the hell are you doing? Just go through this duplicatable system, see what they say. Everything is done to tax code." I said, "Are you really going to miss out on $300,000?
I wouldn't miss out on $1,000, not $300.
Well, that's most of us. I mean, anyways, but go ahead.
Yeah, no problem. Yes, it's worth a call. And like I said, we dare the IRS to audit your ERC or SETC because we know that our CPAs are doing it right. So now what we're going to share, I'm assuming whenever this goes live, we're going to have a QR code that you're going to be able to scan. And what this does is this gets you started on the qualification process. You scan the QR code. It's going to bring up a simple little interactive presentation where it's going to go a little bit deeper into what SETC is. And then it's going to allow you to interact with the presentation and get an estimate on what you could potentially receive based on multiple different factors. And if it makes sense, then you're going to click let's submit. And it's going to take you to another page and walk you through how to submit. You're going to send in, if you don't know your exact amount of money you made during those years, it's okay. Because you're going to submit your 2019 and or 2020 plus your 2021 tax return. and the CPAs are going to review it, and they're going to get it down to a precise science of how much you will actually get back. So don't worry if you're roundabout with your numbers. Before they submit it actually to the IRS, they are going to do it right. And then it's as simple as that. You receive a check, paper check from the IRS in roughly 8 to 14 weeks, which is, if you know anything about ERC, a lot faster than ERC. But, ERC still is moving pretty quick as well.
So I just want to recap. Okay. ERC is when you had paid employees. Doesn't matter if it's an online business, a combination of an online business and brick and mortar. Okay. The self-employment tax credit is for people that are self-employed or they're 1099. So there's a fundamental difference. You can't double dip though.
No.
Yeah, no. So if you've done one, you can't do the other. So you need to evaluate, if you do have employees, what makes better sense. And you probably should try both, because you might get one might be larger than the other one because there is a little bit of overlap.
Correct. Yeah. I mean, if you qualify for the maximum SETC, but then you have, I don't know, call it 10, 15 employees, chances are that amount of money is going to be more. So obviously you're going to want to take the one that's the biggest. So whenever you do submit or go through, and if you have further questions, myself, we're able to talk to you and go through. And if we need to get a CPA involved, we can do that. And they're going to look through everything to make sure that you're getting the one that obviously we want you to get the most money for your business or for yourself. So we're going to go through and do that.
Okay, so we have some questions, Greg. I'm going to let you answer these, but I'm going to read them out. So she said, can we claim for all 3 years? Just asking because the questionnaire asks for 2.
So when you go through the questionnaire, it's going to ask you for your 2020. But with this CPA firm that we use, what they do is they want to know, was your 2019 higher income or your 2020? So when it asks for the 2020, put in your highest gross income or net income from either 2019 or 2020, whichever one it is, and then put in your 2021. So
I believe if memory serves me, when I did it, it prompted me to do that as well.
I think it has an asterisk or some parentheses below that you can record your 2019 if that's higher than your 2020. But if your 2020, go with the higher one. Whichever one was higher, put that in for your 2020.
Okay. Any other questions that you guys have for Greg? Okay, so the last thing that I want to do, and we're right on time, which I love. I want to talk about something that really, really sparked my interest. And this was the original reason why we're going to do this call today, but we pivoted.
Yep.
But, Greg does have a few more minutes. And if you guys, I downloaded this book called The Power of Zero. Okay. It was written by a gentleman that did, he did the taxes for the elite wealthy, right?
He does. He scaled it down to everyday Americans, but he also helps a lot of very, very high net worth individuals.
Right. So he was talking about, the power of this, where you can take, money, and you guys, let's just say you're going to get back $5,000. I highly encourage you to go invest that in something that's in the 0%, because this is how you protect your capital gains. That's either through real estate, infinite banking, or self-directed IRAs. And you can also use self-directed IRAs with real estate and precious metals underneath that. I can't wait to take my class this weekend. It's going to be super cool.
Excited here.
But if you can explain a little bit about this and how people can start moving money from the tax bracket of being up to 37% right now, which is disgusting, over to what we're talking about, the 0%, because you can do this with just, diverting just a couple $100 every single month. So,
correct. Yeah.
Yeah.
So the way I like to look at it is you got 3 buckets. You have the taxable bucket, the tax deferred bucket, tax later, and the never tax advantaged bucket, right? Each bucket should have a certain amount in it, right? Your tax now, that's going to be your emergency fund. Everybody needs an emergency fund because we all know life happens. But if you have too much in that bucket, you're missing opportunity cost and you're going to get taxed at the end of the year. Your bank is going to send you a little 1099, hey, you got $5 in interest on your savings account. Whoop-de-doo. But anyway, so you need to have somewhere between 3 to 6 months of your income or your household expenses saved away where it's extremely liquid. Where life happens, you can pull it from there. And it just depends on your life. If you're a single guy, you're good with 3 months. If you're married, you have kids, you probably need to save up to 6. That tax deferred bucket, that is where most Americans know and go to put their money in. We're talking a 401k or a traditional IRA. Your CPAs, some of your tax preparers are going to tell you to go max out an IRA because it's going to give you more tax cuts on your business, right? The more money you put in, the more you can write off. But the problem with that is it's tax deferred. Tax deferred means tax later. And I don't know about you guys. I've had this conversation with Toni, but I definitely believe that whenever you go to access your money in the future, taxes are most likely going to be higher. And if it's even 1% higher in the future, you are so much better diverting your assets over to the tax-free bucket. Now, am I saying never to use a 401k? No, that would not be of my fiduciary standard to do that if you work with a company and they offer a match. First of all, ask if they have a Roth 401k option, meaning you can put money away into the Roth portion of the 401k account and you can get a contribution, a match from your employer. Take that free money. Take as much free money as you are allowed to take. Walking out your car, $100 bill on the ground, you're going to bend over and pick it up. Take the free money for now. Okay. Now, everything above and beyond that the employer matches. So say they match 4%, give them 4%. If you're available and able to put away 10%, 20%, whatever of your income, let's divert that amount over to the tax-free bucket via Roth IRAs. Not everybody qualifies. We can go over that later. But then you also have other types of ways you can get into the tax deferred, something called an LIRP, which we go over with all of my clients. And that allows you to, no matter how much money you make, you can put as much money in you want per year. There's no contribution limits. There is no income limits on a LIRP.
I know that.
Yeah. Yeah, exactly. Now, let's take it a step further. Since we're talking about businesses and business owners and self-employed, there's a way that since you're not putting money into a traditional IRA where you get a tax cut, a tax write-off, right? You can actually you can put the money into an LIRP properly structured from your business. Your business puts the money away for you. That business now gets a tax write-off. It's called an executive bonus plan.
So what does the acronym stand for?
LIRP, Life Insurance Retirement Plan.
Oh, and there you go.
I do the LIRP, and it depends on your needs. There's multiple different ways to look at it, but this is what the ultra wealthy. I don't know. Harbaugh, your guy, Jim Harbaugh. Yeah, go Big Blue, right? No, roll tide. Anyway, he actually just got a bonus in form of an LIRP. I think about $2 million worth of an LIRP put into his name for a bonus, and the great thing about Michigan, they get to write that off as a bonus.
Oh yeah, they do. They
get to write that off. That's a tax write-off for them.
Yep.
But they gave him a bonus. So this is what the ultra wealthy do. Write off the money. Don't worry about taxes in the future. And then you get to access any of your money if you want to, if you need to buy assets, do these different things. So
I just want to give you an example, you guys. So, we've paid in almost $50,000 to one of our infinite banking accounts. So guess what? Next month, I get to take all that. I can take all that money out and I can invest it. Okay. And I can buy, another share into my self-storage investment or something like that and earn the 20 to 22% that I'm going to get. That's using my own money though.
Yep.
And that's not using money that I have, saved up, because you do need to save up a year's worth of expenses. Without a doubt, it used to be 3 months. Now it's 6 months. Now it's 12 months, just because we don't know what we don't know. But the great thing is that you can totally use that for yourself. Like you could totally take, let's say $20,000 out, and you could buy a car instead of getting a car loan and then pay yourself back. And then that way you're not paying interest.
Well, Toni, why would you want to take your money out of the retirement plan? Why would you want to do that?
Because I'm not paying interest.
Right. And another reason, it's income tax free.
Oh, there you go.
It doesn't know your tax codes. If you loan yourself your own money, you do not pay taxes on income. So it's not counted as income.
Well, there's another thing I didn't know.
Well, another thing I'm going to tell you about it as well. If you use the proper company that structures them, you can loan yourself your own money. There's a fee. There has to be a fee. And in order for you to use a certain company that I recommend, multiple different ones, you have to be able to receive that a wash loan, essentially. So they're going to charge you 3.5% to 5% interest on that amount. Say you take out $20,000, right? You're going to have to pay 3.5% to 5%. Typically, if you take that out, it comes out of the market, correct?
Right.
You don't make any more money. You're losing
Correct.
compound interest on that money until you pay yourself back. If you use the proper companies, they have what's called a participating loan option, which means while they earmark that money for you to use for whatever you need to, and they're going to charge you 3.5% to 5%, your money actually never leaves the market index, where that market index is averaging somewhere between 8 to 12%. So you're netting a profit on your money while you're using your money to buy an asset that continues to generate income for you. That's infinite banking. You can use it if you want to. You don't have to, but taking it a step further with a participating loan is the best way to go.
Yep. So Amy, your question is, yes, LIRP is tax-free. So that's your 0% tax bracket.
Right. And now another thing about the LIRP that is very nice is that 62% of Americans are actually going to have some sort of a long-term care event. So in part of the qualifications for my companies that I look at for my clients, they have to add to where you can use your death benefit, because it does have life insurance. We just earmark it for as little as possible. You can also access that in case of a long-term care event, which can really, really derail a lot of Americans. If something were to happen, if you had a stroke and you can't do 2 living activities, you can't prepare yourself, bathe yourself, transfer, things like that, then all of your assets have to go into spend down. I can get into it a lot further, but I won't get deeper, but you can double that as long-term care for pennies on the dollar.
Well, and let's not talk about, shit getting stuck in probate. And then if you don't have power of attorney, I mean, there's a lot of factors that you have to consider in to all of this. And you guys, here's the one thing that I will tell you that I know, and especially when you become ill, okay, or let's just say you pass, it's really, really important that you have all of this laid out. Very important, because I have seen firsthand, where, that the kids are getting screwed, or, one of the sibs is trying to, upper hand it, or they're trying to hide there's just so many different things. So please be conscientious of really planning out. And this is all about planning. This is not about living just for tomorrow. This is what we've been taught to do, right? Don't plan. You can't be wealthy. You can't create legacy wealth. You can't do this. You can't do that. You can't do, all sorts of stuff. You can. It's all right here for you. It's because the information is suppressed. So that's why I have Greg on here talking about this, because, look at this guy. He's 20 years younger than me, and I'm just learning this shit for the first time now. Better late than never, okay? So here's what I want you to do. You guys, you guys all know how to get a hold of me. I have everybody's contact information. You're going to get the recording with the slides after we get it edited and all that kind of fun stuff here. You can go out and share it. You can review it again, but I highly encourage you, because I know that a lot of you are hearing this for the very first time. And I know that there are people on this call from 30 years old to 65. Okay. There is no better time to start than now. I don't care. It's like starting when people tell me, you're a golden girl. Oh, you're too old to do something, this, that, and everything else. And I'm not just saying that because I'm in that age genre, but I am. But I'm doing shit until I want to do until I'm dead. I'm not just going to sit here and wait for people and, live by society's expectation. It's up to us to break the mold. And that's what we're doing right here, right now. So, and that's providing you with education that you probably have never heard of. So stay tuned.
Exactly.
Greg, do you have any closing remarks? And do we have any more questions while Greg takes us home?
Yeah, we'll give it a couple minutes if you guys got any questions. But one thing I wanted to mention, what she said is, if I knew what I know now, I'm 31. I'm not old by any means, but I'm still pretty young. If I knew what I know now, I would have been putting away $50, $100 a month at the starting at age 18. I would have started as soon as I could, knowing that I want to gather as much compound interest as I can. It's never too late. The amount, just whatever you can afford to put away comfortably. But I know we got some questions running in here.
Well, I'm putting Greg's phone number in the comments. I'm also going to send out all of our his contact information. Okay. Yep. And then, so you guys, if you want to shoot Greg a text, it's 843-801-9750. He does serve nationally.
Yes.
So
I'm licensed in over 20 states now.
Okay, perfect.
Yeah. And for the SETC, there's no requirement. 50 states, we can do it all.
And that's the same with ERC as well.
That's the same with ERC.
Okay. So you guys, if he doesn't have a resource for you to do the life insurance, the infinite banking, the premier banking, then he can refer you to someone in your state. Okay.
Actually, I can get licensed in all 50. I just gotta have people
there you
there
go.
first.
You gotta
I just
have
gotta
people
have people there
first.
first.
Okay. Well, I know there's some people on here from Illinois, some from Colorado, some from Florida. So you guys, I want to thank you so much for your time today. If you have any other questions, this will be continuing education. We will have different topics that we do every Lunch and Learn at Tuesday. Stay tuned. Make sure you tune in for our podcast that's dropped every noon on Monday, and you're going to hear some more snippets from this, and we're going to have some great educational portions, but it's not going to be boring. It's going to be sexy and it's going to be fun, because being truly free is the best feeling in the world. All right,
Exactly.
Greg. Thank you so much. And good luck with you've got your second girl on the way.
Another girl dad.
Girl dad. It's the Kotex Mafia. All right, you guys. Take care. Mwah. Love you. Bye-bye.